Finance Core, Topic 7, Cost of Capital, WACC, CAPM, and Optimal Capital Structure. Readings you might want to skim for this topic are chapters 11, 12, 14, and 15 that cover the CAPM model, weighted average cost of capital, and the discussion of capital structure. In other words, the mix of debt and equity used to finance a business. So learning objective number 1. We're going to understand the cost of capital and estimate weighted average cost of capital, otherwise known as WACC. So cost of capital refers to the annualized rate of return required by a firm's debt and equity capital providers for accepting the firm's business risk and financial risk. So you can think of when a firm is financed and shareholders give capital to the firm in exchange for stock, and when bond holders give capital in return for the bond, or banks lend to the business, there's a certain rate of return that they're going to demand, and we're going to call that the cost of capital. We're also going to call that the required return and also the expected return. So when you see the terms of required return, expected return, cost of capital for both bond holders, debt holders, or equity holders, we're meaning the same thing. Now, this cost of capital that we're going to calculate in a few minutes, it's used as the NPV discount rate, the IRR hurdle rate, and the discount rate to value stocks. So in the previous topics, I've kind of punted on how do I come up with a discount rate? It was always given to you. So I'd say to value Walmart, let's assume a discount rate of 6%. And to do the NPV of this project, assume they have a discount rate of 15%. Or on IRR, make sure they exceed a 10% IRR to accept this project. Now, what we're going to show in this topic is the cost of capital is often that discount rate. Now, the firm's weighted average cost of capital accounts for both debt and equity holders. So again, we're talking about the cost of capital, but when we talk about the weighted average cost of capital, you are accounting for both debt and equity holders, and you're just going to do a weighted average of the two, their required rates of return. So here's our formula for the weighted average cost of capital. It accounts for the equity cost of capital and the debt cost of capital, and it's weighted by the two fractions of the financing. So when we talk about cost of capital, there are two primary sources of funding for a organization. You have debt and you have equity. Now, the funding cost for a company's debt, we'll call it KD in this formula. And also in the textbook, I believe, uses that term KD, the cost of debt. And the interest payments paid to bond and loan holders are tax deductible for the company. So when I talk about the cost of debt, that's the rate of return that the bondholders or the bank requires and charges the organization. However, from the organization's standpoint, they get a tax shield whenever they pay interest. So the after-tax cost of debt for an organization will be KD, the cost of debt, the rate on, say, a loan note, times 1 minus the tax rate to account for the tax shield. Now, we're going to then also look at the cost of equity. So if you issue stock and raise money that way, or use your retained earnings, right, you're using equity holders' money, you have to compensate the equity holders. That rate of return that the equity holders demand or require or expect, we're going to call that KE, the cost of equity. Now, dividends are not tax deductible by the firm. All right, think about the income statement. You do earnings before interest and tax, subtract out interest, and then subtract out the tax. Dividends are after the calculation of after-tax profits. So there is no tax shield for equity. So it's just going to be the cost of equity. Now, to get to cost of equity is going to be a little more difficult. We're going to do that in the next topic or so. And we have to create a model for that. So the weighted average cost of capital looks at what rate of return do your shareholders demand, what rate of return are you going to give your bondholders, and that's going to be after tax, and then you're just going to weight it by the percentage of equity financing in the firm and the percentage of debt financing in the firm. That equity percent is going to be the market value of your stock divided by the sum of the market value of your stock and the value of your debt. And then you're going to weight the cost, after-tax cost of debt by the value of your debt you have in your organization over equity plus debt again. So that E in this equation is the market value of your stock. That would be the total number of shares outstanding times the stock price. All right, the market stock price. D is the value of your debt. Now, ideally, we'd have the market value of the debt, but that's really hard to get. So unlike stocks, debt don't trade significantly from the values, or usually does not trade significantly from their book value, except maybe in a very distressed firm. So the D is often we're just going to take it from the balance sheet, and often we use net debt and not just debt from the balance sheet. In other words, do debt minus cash, especially if cash is not needed for the operations of the business. So we talk about net debt in this equation here for this D. Again, our KE is the cost of equity, our KD is the cost of debt, and that T sub C is the corporate tax rate. So in that topic, we just talked about the concept of cost of capital, how it's used for NPV, discount rate, an IRR hurdle rate, and a stock discount rate for valuation, and we talked about the concept of weighted average cost of capital. In the next two topics, we're going to focus on calculating the two big components of the weighted average cost of capital, and those two components are the cost of equity, which is the next topic, and then the cost of debt, which is the following topic.